Breaking developments out of the Middle East are sending shockwaves through global financial markets this weekend. The United States has officially declared the beginning of major combat operations against Iran. United States and Israeli forces launched coordinated airstrikes on central Tehran, with targets reported near Iran's presidential offices and near the compound of Supreme Leader Khamenei. President Trump stated explicitly that American casualties are possible, saying, and we quote directly, "The lives of courageous American heroes may be lost, and we may have casualties. That often happens in war." The president further stated that the United States intends to annihilate Iran's navy and obliterate its missile industry. In addition, Trump publicly called on the Iranian people to overthrow their government once the airstrikes conclude. Iran responded swiftly and forcefully. The country launched ballistic missile strikes targeting United States military bases across 5 separate nations simultaneously: Bahrain, Qatar, Abu Dhabi, Kuwait, and Saudi Arabia. Iran also launched retaliatory attacks on Israel. In response, Israel stated its goal clearly: to end the Ayatollah's regime entirely. The United Arab Emirates, Qatar, and Kuwait all shut down their airspace in the wake of the strikes. A United States official confirmed that airstrike operations are expected to continue for days, not hours. Iran's foreign minister was compelled to publicly confirm that both the Iranian president and supreme leader remain alive. Iran's government issued a stark warning, stating there are no red lines anymore, and that everything is now possible. Yemen's Houthi movement announced it is resuming attacks on vessels in the Red Sea. Several major oil companies suspended shipments through the Strait of Hormuz. As the situation in the Middle East escalated overnight, commodity markets moved sharply, with physical gold leading the reaction. PayXG, a cryptocurrency token backed by physical gold, spiked to $5,600 per ounce, a gain of 6%, before pulling back to approximately $5,400. That remains well above Friday's closing price of $5,278. The token came within $50 of its all-time high of $5,650 before retreating. Simultaneously, China's spot gold market was reported at 1,226 yuan per gram, which converts to approximately $5,560 per ounce. Western spot gold, by comparison, was trading at $5,278 per ounce. That represents a premium of approximately $282 for physical gold in Asia over Western paper pricing. To put that figure in context, portfolio allocation to gold currently sits at just 1 to 2% for most investors, and that is occurring while physical gold trades nearly $300 above paper prices in the world's largest gold market. In Thailand, a major Southeast Asian gold dealer known as Ha Sang Hung halted trading operations entirely, citing excessive price volatility as the reason for the suspension. The halt underscored the degree of pricing disruption being experienced across physical markets. Silver markets told a similar story. Silver was reported trading at $95.14 on the hyperliquid platform. Shanghai spot silver was quoted at $105, while Shanghai futures were at $108. Western spot silver, by contrast, sat at $93, a $12 gap between physical prices in the East and paper prices in the West. That premium, which had previously been characterized by some analysts as temporary, widened further during the escalation. Bitcoin, meanwhile, moved in the opposite direction. The cryptocurrency dropped sharply to $63,000 following news of the strikes on Tehran. Over $100 million in leveraged long positions were liquidated within 15 minutes of the news breaking. While physical gold was setting new all-time highs in Asian markets, Bitcoin declined, a divergence clearly reflected in overnight price action. Before the military escalation became public, silver markets were already displaying notable stress signals in their underlying data. On the COMEX exchange, registered silver inventory increased by 2.3 million ounces, while eligible silver inventory fell by 2.6 million ounces. Total COMEX silver stood at 360.3 million ounces. Open interest on silver futures dropped significantly, from 162,000 contracts approximately 1 month ago to 118,000 contracts currently. That represents a decline of 27%, and it occurred while silver prices climbed from the 80s into the 90s. The March futures contract outperformed the May contract for 4 consecutive days. Silver lease rates rose for 6 consecutive days, reaching 1.6%. The silver swap rate moved to its most negative level since February 18th. These positioning developments were in place before the military news broke. In China's Shenzhen region, one source reported the largest recycling company offering $15 per ounce above spot for 99.99% pure silver. a figure that reflects both industrial and investment demand, paying significant premiums to secure physical delivery. In Shanghai, a reported premium of $12 between physical and paper silver prices was already present and widened further following the overnight escalation. Thailand's gold dealer suspension added another data point to a broader picture of physical and paper markets operating at diverging price levels. On the gold side, exchange-traded fund holdings were reported at their highest level since mid-February. Central bank purchases were described as ongoing. Mine supply was characterized as unable to keep pace with demand. The article notes 10 consecutive monthly green closes on silver and gold's 7th consecutive record close as additional context for where these markets stood heading into the weekend. With Western futures markets closed for approximately 30 to 40 hours from the time of reporting, price discovery was occurring through alternative channels. PAX-G, trading on cryptocurrency infrastructure, reached $5,560 overnight. China's spot market quoted the same general level. Hyperliquid showed gold at $5,414 and silver at $95. These figures were being reported not from paper futures exchanges, but from markets that remained open while COMEX was closed. The report also notes several factors that could work in the opposite direction. Futures markets can gap and then fill upon opening. The strikes could de-escalate. Iran may not escalate its response further. The Strait of Hormuz could remain functional. Physical premiums can compress if paper markets move sharply lower when trading resumes. The report acknowledges that coordinated bank activity has previously pushed gold and silver lower during geopolitical events, and that both metals have historically pulled back after initial spikes once a crisis passes. To summarize the 6 major developments reported this weekend, United States and Israeli forces began major combat operations against Iran. Strikes targeted locations near Iran's Supreme Leader and President. Iran launched attacks on United States bases across 5 countries. Iran conducted retaliatory strikes on Israel. Officials stated that strikes are expected to continue for days or potentially weeks, and Israel stated its explicit goal as ending the Ayatollah's regime. Looking at the indicators the report identifies for monitoring in the hours ahead, these include the duration and intensity of ongoing strikes, whether Iran escalates beyond its initial 5-country response, whether Strait of Hormuz closures expand or stabilize, the size of any gap when COMEX futures open, whether COMEX registered inventory continues to drain, and whether the Shanghai premium on silver widens beyond $12, or the gold premium widens beyond $300, or whether both compress when Western markets resume trading. That is a full account of the developments reported across military operations, geopolitical responses, and commodity market movements as of this broadcast. The situation remains active, with Western futures markets set to resume trading within the next 30 to 40 hours. We will continue to monitor all developments as they unfold. This has been your news update. Stay informed, stay with us.